What if I told you there's a strategy in the stock market where some investors try to collect a dividend in just 1 or 2 days? Imagine buying a stock today, holding it for a very short period of time, collecting the dividend payment, and then selling the stock right after. On the surface, it sounds like a simple loophole, almost like free money from the market. This idea has become very popular online, especially among beginner investors who are looking for quick passive income. You may have even seen people claiming that you can hack the dividend system using something called the Ex-Dividend Date. According to this theory, all you have to do is buy the stock right before a certain date, hold it briefly, and you'll qualify for the dividend payment even if you sell the stock immediately after. Some traders call this the dividend capture strategy, and it sounds incredibly tempting because dividends are real, cash payments companies distribute to shareholders. But here's the big question that most people don't stop to ask. If collecting dividends this easily was possible, wouldn't everyone on Wall Street already be doing it? And if millions of investors were using the same trick, could it actually remain profitable? The truth is that the ex-dividend date strategy is one of the most misunderstood concepts in dividend investing. While the idea sounds simple, the mechanics behind it are much more complicated than most people realize. And there are several hidden factors that can completely change the outcome of this strategy. In fact, many beginners who attempt this so-called free dividend trick end up discovering that the stock market is far more efficient than it appears. So, in this video, we're going to break everything down step by step in the simplest way possible. First, I'll explain exactly what the ex-dividend date is and why it's so important when it comes to receiving dividend payments. Then we'll walk through how the famous dividend capture strategy actually works, and why some traders believe it can generate quick income. After that, we'll look at the reality behind the strategy, including the hidden risks that most people never talk about, such as price adjustments, taxes, and market volatility. By the end of this video, you'll clearly understand whether the ex-dividend date loophole is a legitimate strategy used by smart investors or simply a misleading concept that sounds good in theory but rarely works in practice. If you're interested in dividend investing, passive income, and smarter ways to grow your wealth in the stock market, this is something you definitely need to understand before putting your money at risk. Before we talk about the ex-dividend date loophole or the dividend capture strategy, we first need to understand a very simple concept. What exactly is a dividend? In the stock market, a dividend is a payment that a company distributes to its shareholders, usually from its profits. Think of it as a reward for owning shares of a business. When companies make consistent profits and generate strong cash flow, they sometimes choose to share a portion of those earnings with investors in the form of dividends. These payments are typically made every quarter, although some companies pay monthly or annually. Many well-established companies are known for paying dividends for decades. For example, companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have built strong reputations for consistently rewarding shareholders with dividend payments. Investors often buy these types of companies because they provide a combination of steady income and long-term stability. Dividends are especially attractive for investors who want passive income. If you own shares of a dividend-paying company, the company sends cash directly to your brokerage account whenever a dividend is paid. Over time, those payments can add up and become a reliable income stream. But dividends aren't random payments. There are specific rules and important dates that determine who actually receives the dividend and who doesn't. Simply buying a stock at any time does not automatically guarantee that you'll receive the next dividend payment. There is a timing system that the market follows, and understanding that system is the key to understanding the strategy we are discussing in this video. One of the most important dates in that system is something called the ex-dividend date, and this single date is what led many traders to believe they had discovered a loophole in the dividend system. To understand the so-called dividend loophole, we need to understand how dividend payments are actually scheduled. Whenever a company decides to pay a dividend, it announces several key dates that determine who qualifies to receive that payment. These dates include the declaration date, the record date, the payment date, and most importantly, the ex-dividend date. The declaration date is when the company officially announces that it will pay a dividend. This announcement includes the dividend amount and the important dates associated with it. Next comes the record date. This is the date when the company checks its records to see which investors are officially listed as shareholders. Anyone who appears on the shareholder list by this date will receive the dividend. However, because stock trades take time to settle, the market uses a special cutoff date called the ex-dividend date. This is the most important date for investors. If you purchase a stock before the ex-dividend date, you are eligible to receive the dividend. But if you buy the stock on or after the ex-dividend date, you will not receive the upcoming dividend payment. For example, imagine a company announces a dividend of $1 per share. If you buy the stock before the ex-dividend date, you will receive that $1 dividend even if you sell the stock later. But if you buy the stock on the ex-dividend date or afterward, the dividend will go to the previous owner of the shares. Here's the part many investors don't realize. When the ex-dividend date arrives, the stock price usually adjusts downward by roughly the amount of the dividend. This adjustment happens because the company is distributing part of its value to shareholders. Once the dividend is removed from the company's balance sheet, the stock price reflects that change. And this price adjustment is exactly where the famous dividend capture strategy begins. Once investors understood how the ex-dividend date works, some traders believed they had discovered a clever way to generate quick income from dividends. This idea eventually became known as the dividend capture strategy. The strategy is based on a very simple concept. Buy a dividend-paying stock right before the ex-dividend date, hold it just long enough to qualify for the dividend, and then sell the stock shortly afterward. In theory, this sounds like a very attractive strategy. Imagine you buy a stock one day before the ex-dividend date. Because you own the shares before that cutoff date, you qualify to receive the dividend payment. Then, once the ex-dividend date passes, you could sell the stock and move on to another dividend opportunity. Some traders repeat this process across multiple stocks throughout the year in an attempt to collect dividends repeatedly. Investors often attempt this strategy with high dividend companies such as AT&T, Verizon Communications, and Pfizer because these companies are known for consistent dividend payments. On the surface, the strategy appears simple: buy before the dividend, collect the payment, and sell shortly afterward. If it worked exactly like this, it would essentially allow investors to generate frequent dividend income without holding stocks long-term. Because of this idea, many people online describe dividend capture as a free dividend trick or a loophole in the stock market. It gives the impression that investors can quickly collect cash payments without taking significant risk. But the reality is that the stock market is far more efficient than most beginners expect. Professional investors, hedge funds, and trading algorithms have already analyzed these strategies in great detail. And once you look deeper into how stock prices behave around the ex-dividend dates, the supposed loophole starts to disappear. At first glance, the dividend capture strategy sounds like easy money. But the reason it rarely works the way beginners expect comes down to one critical factor: stock price adjustments. When a company pays a dividend, that cash is leaving the company and going to shareholders. Because the company is now worth slightly less after distributing that cash, the stock price typically adjusts downward by approximately the amount of the dividend on the ex-dividend date. Let's look at a simple example. Imagine a stock is trading at $100 and the company announces a $1 dividend. On the ex-dividend date, the stock price will usually open around $99 instead of $100. This means that, although you receive the $1 dividend payment, the value of the stock you own has dropped by about the same amount. In other words, you didn't actually gain anything. The dividend payment is effectively offset by the decrease in the stock price. Instead of receiving free money, you're simply transferring value from the stock price into a cash payment. But the situation can sometimes be even worse. Stock prices don't move in perfectly predictable ways. If market conditions are negative or investors begin selling the stock, the price may fall by more than the dividend amount. In that case, the investor attempting the dividend capture strategy could actually lose money. Another factor to consider is trading costs and taxes. Depending on where you live, dividend payments may be taxed differently than long-term capital gains. Frequent buying and selling can also increase trading costs and reduce overall returns. Once all of these factors are considered, the idea of a simple dividend loophole starts to look far less attractive. Even though the dividend capture strategy sounds appealing in theory, it carries several risks that many beginner investors underestimate. The first and most obvious risk is price volatility. Taxes are another important factor. In many countries, dividends are taxed at a higher rate than long-term capital gains. This means that even if the strategy appears to break even before taxes, the tax burden could turn it into a losing trade. There is also the issue of opportunity cost. Capital used for short-term dividend capture trades could potentially be invested in long-term opportunities that generate significantly better returns. Many successful investors prefer holding diversified funds like Vanguard S&P 500 ETF or SPDR S&P 500 ETF Trust because they provide exposure to hundreds of companies and historically strong long-term performance. Finally, professional traders and large institutions already monitor dividend opportunities very closely. Because these market participants have advanced technology and massive capital, they can quickly exploit any short-term inefficiencies that appear in the market. As a result, most potential advantages of dividend capture strategies tend to disappear quickly. Although dividend capture strategies are often promoted as an easy income trick, the reality is that they are extremely difficult to execute consistently for individual investors. However, there are certain situations where variations of this strategy may be used by professional traders or large financial institutions. Institutional investors sometimes use dividend capture as part of a much larger trading strategy. For example, hedge funds may combine dividend capture with options trading, hedging techniques, or arbitrage strategies to reduce risk while attempting to benefit from small pricing differences in the market. These complex strategies require advanced tools, deep market knowledge, and extremely fast execution that most retail investors simply do not have access to. Another scenario where dividend capture might occasionally work is during temporary market inefficiencies. Sometimes a stock may not adjust perfectly to the dividend amount due to unusual market conditions or low trading volume. However, these opportunities are rare and usually disappear quickly as other traders move in to take advantage of them. For most individual investors, focusing on long-term investing tends to be a far more reliable approach. Instead of trying to capture dividends over a few days, many successful investors build portfolios of strong companies and hold them for years. Over time, these companies can grow their earnings, increase their dividends, and potentially provide both income and capital appreciation. This long-term approach is the foundation of many successful dividend strategies used by investors around the world. Rather than chasing quick payouts, they focus on owning high-quality businesses that consistently reward shareholders over decades. So while the idea of a dividend loophole may sound exciting, the real power of dividend investing usually comes from patience, discipline, and long-term ownership of great companies. Before you try the dividend capture strategy, it's important to remember one thing about the stock market. If something sounds like easy money, there's usually a hidden catch behind it. The idea of collecting dividends in just a few days by timing the ex-dividend date sounds incredibly appealing. And that's why this strategy keeps spreading across investing forums and YouTube videos. But once you understand how the market actually works, you realize that the so-called free dividend trick isn't really free at all. Stock prices adjust, taxes can reduce your returns, and unexpected market movements can quickly turn what looks like a simple trade into a losing one. That doesn't mean dividends are bad, far from it. In fact, dividends have been one of the most powerful wealth-building tools for long-term investors. Many of the world's most successful investors didn't chase quick payouts. Instead, they focused on owning strong companies that consistently grow their earnings and reward shareholders year after year. Companies like Coca-Cola and Procter & Gamble have been paying and increasing dividends for decades, and investors who held these businesses long-term benefited from both rising dividend income and long-term stock price growth. That's the real secret most beginners eventually discover. Wealth in the stock market usually comes from patience, not shortcuts. Instead of trying to outsmart the market with quick dividend trades, many experienced investors focus on building a portfolio of quality companies or diversified funds like Vanguard S&P 500 ETF and holding them through time while dividends compound over years and decades. That compounding effect can become incredibly powerful. So the next time you hear someone talk about a dividend loophole, remember this: the market rarely gives away free money, but it does reward investors who think long-term and stay disciplined. If you enjoyed this video and want to learn more about smart dividend strategies, passive income investing, and hidden opportunities in the market, make sure you subscribe to the channel and check out the next video where we break down some of the best dividend stocks that investors are watching right now.